And you should now be able to, because I know some folks were having some issues with their internet connection and stuff. So if you miss parts of the lectures now, the intro lecture is there, chapter 1, part 1, chapter 1, part 2, and then of course, chapter 1, part 3, I'll go ahead and stick here, and it will include, God willing, here we get through chapter 1, and it should include part of chapter 2, part 2. So as I've mentioned a couple of times, sometimes there'll be an overlap as we're completing one chapter and getting into the other. So if you want to see the start of that next chapter, you have to watch the back end of that video, and then going forward, I'll start posting those under the appropriate chapter as we finish up the chapter. Okay. Question on that?
Yes, Professor. We were talking about using my transcript for the worksheet for the CPA to get ready to sit for the CPA exam.
Yeah.
Well, I just got my updated transcript. Some of the classes weren't on there for some reason, but I'll be emailing that to you again.
Okay. Yeah, either email that to me, and then I should have some time tomorrow if you want to talk about that live as well. So.
All right. Thank you.
Yeah. Any other questions? Okay, let's go ahead then and let's jump ourselves on in, see where we land. Okay, pretty exciting. So I am trying to find my, okay, and unless I'm mistaken, I think we had cut off here. Okay, now this area for the July exam, they're saying that they're going to limit the discussion on communication with component auditors. And so my sense is that this information that we're going to cover here will probably go away or be de-emphasized in July. But since I know that a couple of you are going to try to knock it out in June, and they are a little vague in what they mean by communication with component auditors, I think it's worthwhile that we go ahead and look at this information. Okay, so you take a look, and you have a set of consolidated financial statements. Let's just kind of do a little visual here. Right, and when you have the consolidated financial statements, say you have company A and you have company B that are under the same ownership. Okay, COB is not, looks like I'm trying to say close of business. Company A, company B, right? Okay, and they constitute the consolidation, right? You consolidate company A, company B, you get a set of consolidated financial statements. Well, the way they're referring to this here is a set of group financial statements. Okay, so you have the components that make up the group. Okay, now what happens? It could work that you have a group auditor that is responsible for the audit of the consolidated financial statements. So you'll have a group auditor. That group auditor will be responsible for auditing the consolidated financial statements. And then you could have a component auditor. And the component auditor would be responsible for, say, doing audit work of one or more of the components. Now, typically what happens is the entity that is calling themselves out or being engaged as the group auditor, they're probably auditing the larger component, and then a component auditor is probably auditing smaller components. Okay, in order to call yourself the group auditor, you have to be auditing enough of the pieces to say that you are the group auditor. For example, in my office, the GAO, Government Accountability Office, I've mentioned in our introduction that I was involved in the audit of the consolidated financial statements. GAO is called out in legislation as the auditor of record of the consolidated financial statements. But because the auditing standards say that in order to be called the group auditor, you have to audit enough of the pieces. The legislation called out that GAO automatically will not the sea creature, the otter, will audit the Bureau of Public Debt and the Internal Revenue Service directly. And the reason the legislation called those two out is that the public debt is the big hitter on the balance sheet for the federal government, and the IRS is the big hitter on the income statement. Other pieces of the consolidated, smaller agencies are audited by component auditors, okay? So what we're going to see is that the entity that's involved in auditing the group audit, the consolidated, and they probably audit certain components as well, but they are responsible for directing the work of other auditors that we're referring to here as component auditors. And we're going to see, remember, we're still in the chapter on reports right now. We're going to see how when group auditors get involved, how that could potentially impact our audit report when we have other auditors involved. Okay. Any question on that before we get started? Looking at the outline here. Okay, good. So you have what? You have the group engagement partner, the group engagement team. They are the ones that are essentially in charge of what? In charge of the consolidation. You have the component, right? This is essentially a component right here where I'm showing you. I kind of misguided my arrow a little bit. Okay, that's the component. And then you have what? And then you have the component auditors. Those are the auditors that are responsible for auditing pieces. And you have the group financial statements. Okay, now again, just because you're the group auditor doesn't mean you don't do any work at the component level. You probably will pick out the biggest component, audit that directly, and then rely on the work for some of the smaller components from the component auditors. Okay. Okay, good. So let's just go ahead then, now that we sort of understand that terminology, and let's see what the responsibility is of the group engagement team. And they have to understand certain things about the component auditors. And this becomes important because we're going to rely on their work. So we don't want, derelicts going in and doing that work, and then we have to rely on it or go in and clean up a mess that they've created. So we're going to want to understand some things about them going in. So first thing, most importantly, are they independent? Okay, that's a disaster if you have somebody that's not independent doing some work for you on a component, and then you're going to rely on that for the group, for the consolidated financial statements. That's a problem. You're going to have to go back and redo that work if you find out after the fact they were not independent. Okay, what is their competence? Okay, to what extent will the group engagement team be involved in the work of the component auditor? I would always get irritated, to be honest with you, back when I was with the GAO, because for some reason, I always got assigned to audits where we were auditing directly. So I was on the audit of IRS. I was on the audit of public debt. I was leading work on the auction issue cycle for the public debt. Back then, they used to roll over about $2.5 trillion a year in debt. And I was in charge of running that work for the GAO for several years. And then there was those pieces, those components that were audited by others. But what would happen is GAO would assign individuals to basically look at some of the work that was done by those component auditors, and they would do that work. And then when it came time, the end of the year for, bonuses and that sort of stuff, they'd hold these people up as, oh, look, he did a great job reviewing the component, and I'd always be sitting there going, well, yeah, but I was auditing an entity, a big chunk of an entity directly. So anyway, my bottom line is not to complain about my career, but to point out that even though you're not auditing that component directly, you will likely have a fair amount of involvement with those component auditors to make sure you're satisfied that that work is progressing the way it should. Okay, so you're going to want to understand whether the group engagement team will be able to get information needed for the consolidation process, because at some point we're going to have to look at their work when it starts to consolidate up, and whether component auditors operate in some sort of regulatory environment that you would need to consider. Okay, so flashcard that. We got to understand something about those component auditors. And then the big decision is whether or not we are going to make reference to those component auditors in the audit report of the consolidation. So you have two options. You can either refer to them and talk about the amount of work that they did of the component pieces and how that fits into the overall consolidation, or you won't mention them. It'll be as though they're not involved at all. Now, which of those scenarios do you think you're going to have more involvement in the work of the component auditors? If you don't mention them at all, or if you mention the amount of responsibility that they took?
If you reference them.
No, you're going to have to do more work if you don't reference them. If you reference them, you're basically partitioning off what they're responsible for. Now, that doesn't mean you ignore them, but you still will have to do some work to understand what they did. If you don't mention them at all, well, now you're assuming responsibility for their work, because the user of the audit report doesn't even know that they were doing work. So at that point, you're going to have to go in and direct their efforts much more, review their work much more, redo some of the testing and whatnot that they did, because now you're assuming responsibility for whatever they did. Okay, so let's just look at this and note that the options are to either make reference, that's option one, or coming over, and I'm going to look at some of that material, come back to some of that material, or two, not make reference, or option two, make reference to them. Notice the difference in color, because one is make reference, the other is not make reference, but it's not necessary for you to change your colors if you don't want to. Okay, all right, good. So let's just go over and let's take a look at option one. Okay, and we say that when the group engagement partner decides to assume responsibility for the work of the component auditor, no reference to the component auditor is made in the auditor's report. Okay, so we are not going to make reference to them. We are going to assume responsibility for their work. Okay, now let's take a look at what that means then. As a result, when the group auditor is assuming responsibility for the work from the component auditor, the group engagement team should determine the type of work to be performed on the financial information of the components. Flashcard that, but you start to do what? Component auditor, group auditor.
I have a question.
Okay, one second. Group auditor directs the component auditor. And maybe I should put the word directs on top of that arrow. So you're almost like their supervisor. Okay, go ahead. What was the question?
Does any of this make a difference if the group auditor and the component auditor are from the same firm or from different firms?
It's assumed they're from different firms in this situation. If they're from the same firm, then it's not really contemplated that there are component auditors. So when we start calling out component auditors, it's assumed that they're not under the same management structure for the CPA firms.
Okay, because in your example, when you're talking about the GAO, the component auditor was from the GAO as well in your example?
Oh, yeah, no, let me clarify. Yeah. So what I was saying is GAO, audited, the consolidated, and certain big components, IRS and public debt, right?
Mhm.
Okay. But then for other pieces, for example, I'm trying to think, for other parts of the Treasury Department, their inspector generals did the work of other parts of the Treasury Department, because IRS at that time, public debt was part of the Treasury. So
Okay.
DL picked up those, but for other parts of the Treasury, like customs inspector generals audited that. Okay, but what happened is they would audit that as component auditors. They would audit, say, customs, Treasury Inspector General would, but or maybe it was Customs Inspector General. But what would happen is GAO auditors would come back in behind them and look at the work that they did.
Okay.
Okay, so, but it was a higher level review. It was stuff like looking at things that were only material and whatnot, where I was on an engagement where I was having to do the whole audit, not by myself, I had a whole team, but I was having to do a whole chunk of that audit, doing the audit work directly. So that was my only point, is that I felt it was unfair, maybe my story went too far, that they would get all this credit at the end of the year because they had a smaller task. Whereas I was pulling off a much larger task, in my opinion, yet they were getting more credit. It felt like maybe I should talk to a psychiatrist about it. But anyway, so the group auditor directs the work of those component auditors when you're not going to make reference. Okay, so you say, we want you to do this work and we're going to come back in and we're going to review that work. Okay, now to what extent, whereas when you're doing work directly, you're not doing that. You're doing the work. You're having to manage it, the whole works. Okay, now what happens? The group auditor now is going to have to go, and a significant component is a component that individual significant to the financial statements, either because of risks or because of materiality. Okay, so significance due to individual, a component group that is significant due to individual financial significance, should be audited by the group engagement team or the component auditor. But if it's audited by the component auditor, then you're going to have to do more work. Okay, you're going to have to look in, come in behind them and do more work looking at that. So that's a materiality consideration. And then you also look at it from a standpoint of risk. Okay, so even though a component may not be as material, it could be more risky. Okay, so if a component that is significant because likely to include significant risk of material misstatement to the group financial statements, the group engagement team or the component auditor should perform an audit of the financial statements. Okay, so again, when you have components that are material and are risky, the more involvement that we expect there to be of the group auditor, and then the component auditor as well will have to do some work there. If you have some significant components, then maybe you don't have to have as nearly as much involvement of the group or the component auditors, and you should do some analytical procedures. Okay, so again, I know it's a little bit confusing, but you've got what? You've got the group financial statements, you've got the group auditor, component auditors. What's going to happen? Group auditors are going to pick up a major component, do audit work directly on that. They're going to direct the work of component auditors, but it's not like they can just ignore the work they do. They're going to have to review it and whatnot, even though they may not be doing as much direct audit work. If you have some small and significant components, you don't have to do nearly as much work with those, but you will have to at least do some analytical procedures to make sure you're satisfied with their financial information. Now, that is what's required under option 1 when you're going to make reference. If you're not going to make reference, which is option 2, okay, reference when you are going to make reference, which is option 2, reference and component auditors should not be made unless they have done the work according to the appropriate standards, of course, and the component auditor's report is not restricted, okay? And so when you decide to make reference to them, okay, then when making reference, component auditor should clearly indicate in the auditor's responsibility paragraph for non-issuer. I almost sent Becker an email today to say, and the opinion paragraph. I don't know why they didn't mention the opinion paragraph as well. For non-issuer, it's going to affect the auditor's responsibility paragraph and the opinion paragraph. And for a issuer, for a public company, it's going to affect the opinion paragraph and the basis for opinion paragraph for a non-public, for a public company, okay? And basically what you're going to say in your report is that the component was not audited by the auditor of the group statements, but was audited by a component auditor. The magnitude of the portion of financial statements audited by the component auditor when the component's financial statements are prepared using a different financial reporting framework. What was that framework? And don't worry about that last part. They're getting a little granular there. Just that part right there, okay, is all I want you to flashcard. Don't worry about this other part. Okay, now flashcard that though, and you will literally come out and call out the percentage that was audited by those other auditors. Okay, and if you do that, if you make reference to them, then all this stuff up here where you're trying to figure out how much you're going to be involved in directing the efforts of those component auditors, you don't have to do all that. You do less work because you're dividing the responsibility. You're saying, hey, the component auditor is responsible for these pieces of the overall audit. Now, in the case of the GAO, Congress made it clear that they did not want GAO to sit there and divide responsibility between component auditors and the GAO. They wanted the GAO to be the auditor of record of the consolidated financial statements of the federal government. And so we do not make, I don't work there anymore, but at the time it was a we did not make reference to them in our report. And therefore we had to have folks go down and do some of this additional work up here on the components. I don't think it was as important as the work that I did directly on the big components, but for those smaller components, we did have teams go in and look at some of the work that they were doing. Okay, question? Okay, good. So let's just take a look at the next page. There's a couple things here. Modified opinion. So if the opinion of the component auditor is modified, or the reports include an emphasis of matter paragraph, the group auditor should determine the effect on the auditor's report. And when appropriate, the group auditor should modify the opinion on the group financial statements or include the emphasis of matter or explanatory paragraph, depending on whether we're talking about a public or non-public company. So flashcard that. So example there, again, going back to my experience with the GAO, Department of Defense gets a disclaimer of opinion on its financial statements by the DoD auditors. And I think there it's private firms. I think, if I'm not mistaken, it was KPMG for years. It was trying to audit the Department of Defense. And at the end of the day, they always disclaim an opinion on the Department of Defense's financial statements. Now, sometimes students think, well, that's because DoD has secret things that the auditors can't look at. No, you can get the auditor the appropriate clearance to look at any nuclear secrets or whatever. You're just gonna have to get them the clearance. That's not the problem. The problem is that the Department of Defense has a horrible asset management system. They can't tell you enough about their assets at any point in time. And so as a result, I think it's KPMG disclaims an opinion on the Department of Defense financial statements. And it's not the only reason, but that's one of the reasons that the GAO cites as to why it's having to disclaim an opinion on the consolidated. So a disclaimer can bubble up from one of the components and be significant enough to result in a disclaimer on the consolidated, or a qualification on one of the components can be significant enough to bubble up and result in a qualified opinion on the consolidated statements. Whatever, if it's significant enough, something that's happening at the component level can bubble up into the report on the consolidated. And I believe there is a simulation, a task-based simulation in your homework for A1 that considers how things happening at the component level affect the consolidated. And that's a good exercise. Take a look at that. Okay. Okay, good. Now let's just look briefly at the report here, just to see, as we said, it'll affect the auditor's responsibility paragraph. And then I had you write in that it'll also affect the opinion paragraph. So in the auditor's responsibility paragraph, notice they come right out and tell you what was audited by component auditors and how that constituted certain percentages. Now, this is obviously the situation where you are making reference. If you're not making reference, it's the report you memorized, assuming it's not unmodified, right? Okay, but if you make reference, you see we mentioned the other auditors in the auditor responsibility paragraph, and we do mention the other auditors in the opinion paragraph. That's why I got mad and had you write that in. I don't know why Becker didn't mention that it does affect, although to a small level, the opinion paragraph for the non-public companies. Okay, when you indicated the division of responsibility between you and the component auditors. As we said, for the public companies, it does affect the opinion paragraph, and it affects the basis for opinion paragraph. And they said that, they called out that correctly, and we flashcarded that. Okay, question? All right, good. Let's look at our first multiple choice question for tonight. Okay, make sure you're giving this a good attempt. I'll give you a couple minutes to look at it. Okay, I'm gonna go ahead and stop the poll. So I see that there's those same two, seem like every class we've got two participants that don't participate. Who are you?
The one actually I just switched from my phone to the laptop, and for some reason I don't see the poll at all. So I
Okay, thank you. Who's the other one? Okay, all right, guys, gotta participate. Don't get me into a role taking thing every class now. You're in trouble because you're in a small class and I can do it. Okay, all right, good. Most of us got it right. Okay, most of us got it right. The answer is D. Now I had two people that said that they thought A was the right answer. Okay, so D is the correct answer here. And I'm going to go ahead and stop the results so it won't show on the recording when I'm going through this question. The group auditor decides not to refer to the component auditors who audited a subsidiary of the group auditor's client. In this situation, the group auditor most likely would, okay? And if they are not referring to them, then anything that talks about an effect on the report is wrong because we're not referring to them. So we're just issuing an unmodified opinion, right? And we're not referring to them. So I get a little flabbergasted when I see, creativity creeping in here and we start talking about how we would add an emphasis of matter. If we don't refer, we don't do anything to the report. We just issue the report. Further, nowhere in our discussion up here did we talk about there being added new paragraphs. We simply took the paragraphs that we had, the opinion, the basis for the opinion, the auditor's responsibility in the opinion paragraph where we're talking non-public companies, and altered them. So there was no emphasis of the matter report that got in. So does anyone want to tell me why you would think A would be correct?
I didn't choose A, but I think maybe you could have gotten confused on the last topic we discussed where if the component auditor issues a modified opinion, then the group auditor, like when they are referencing the comp auditor, then they have to, when appropriate, that flashcard that we made, when appropriate, group auditor should modify the opinion and or include emphasis of matter paragraph. So maybe I didn't choose that A, but maybe that's why you could have gotten confused.
Well, I was gonna say something on that lines. I chose A, but yeah, that's why I chose it, because the conversation that was brought up by the other student that you answered about whether it's gonna be more work or less work.
Okay, I'm not sure I understood the first comment that was made. I didn't understand that second one. So let me deal with the first one first. The group auditor decides not to refer the component auditor who's subsidiary of the group auditor client. In this situation, the group auditor, and so I'm still not quite seeing how you could jump to, or how somebody could jump to the idea that if there's a modification in the report for the component, that bubbles up into modification of component issue into something component auditor. If you're not making reference to them, add an emphasis of matter paragraph. I mean, I think the this part of the question, the stem of the question would have had to have been more specific to say, well, there's been a qualification by the component auditor in the component auditor's report, how would that affect the group auditor's report, to start talking about bringing an emphasis of matter paragraph. And then, you know, are not, there is no statement that they are not material to the consolidated financial statements. If they're not material to the consolidated, I'm not going to even look at them. I don't look at immaterial things. Okay, so that was the other thing to indicate to you that A was wrong. Now, what was this? I didn't understand how the question that I had talked about with more work impacts you, motivated you to pick A. Can you repeat that?
Well, yeah, it's probably just me reading into it too much. I just got confused. I'll just leave it there. I just got confused.
Okay, okay. Not referred. Document an engagement letter that the group auditor assumes no responsibility. That's ridiculous. If we are not mentioning them, we're assuming responsibility. Obtain written permission from the component auditor to omit reference. We said nowhere said that's the case. And why would we have to get their permission to not mention them? It's our decision whether to mention them or not mention them as the group auditor. And of course, D, yeah, I'm going to direct the work of the component auditor if I'm the group auditor. Okay, question? Okay, good. Let's go ahead. And I apologize for the length of chapter 1, guys. I think they just tried to pack way too much into this first chapter. So I think after we get past this first chapter, it's going to flow along a little better for you. I feel like they have so many things in this first chapter that at some point your head starts to explode on this. So I think for this first chapter, it's going to be critically important that you're making the flashcards that I'm asking for here to kind of bring down to a mild roar all the different things that start to get covered in this chapter. Okay, okay. They put them all in this one chapter because they all are saying they affect reports, but I think they should have figured out a more strategic way to kind of move this stuff around in different places, so we're just not getting overwhelmed in the very first chapter with all this stuff. Okay, but it is what it is, so let's roll with it. And we have broken it into 3 different lectures, so that'll probably help too if you got to go back and review any of this. Okay, good. Let's go ahead and let's take a look at this next one. An auditor may be engaged to audit and express an opinion on a single financial statement, account item, or financial statement. Okay, we're going to count the line item of a financial statement. What does that mean? Oh, let me make another note here. This is going away in July. Okay, that's going away in July, but I'm going to look at it anyway because it's just a couple pages, although a little bit kind of hard stuff to digest. But it's since I got a few folks that are going to be taking the exam, I think I should, before July 1st, I think I should go through this with you just to untangle some of it. Okay, so what happens? You could be engaged to not audit all of the financial statements, balance sheet, income statement, statement of cash flow, statement of stockholders' equity. You will be engaged just to audit one of those statements, just the balance sheet. Perfectly okay under the standards, okay? Or you could be asked just to audit the income statement and not be asked to audit and give an opinion on the other statements. That's okay, okay? You can do that under the standards, okay? Now, when you audit a single financial statement, and you could be asked just to audit a line item, say accounts receivable, you could be asked to do that, and call that a specific element, okay? Then it could be performed as part of an audit of the complete set of the financial statements, or it could be just being asked to audit the one financial statement. So if you're auditing the complete set of statements, they're going to ask for an opinion on the entire set of financial statements, but then maybe ask you to give an opinion that just calls out a specific line item, or just, well, probably it would be a specific line item at that point, because when you give an opinion on the whole set of financial statements, you call out the balance sheet, right? So they could ask you, say, hey, give us an audit on the complete set of financial statements, and then give us an audit and opinion on just a single line item, because maybe a bank or somebody's asking for that. Or it could be that maybe an auditor has to disclaim an opinion on the complete set of financial statements, but you could get enough evidence, say, to support an opinion on just one line item. Okay, so you could be giving it as just a standalone engagement. I'm just auditing the balance sheet, I'm just auditing accounts receivable, or in conjunction with an audit of the financial statements. Okay, now you come over and they give examples of specific elements accounts. Account receivable is a good one, I think. That's a fairly common one, because often an entity will be getting a loan, and they'll be getting that loan based on what? Based on the situation where they're, sorry guys, I'm getting distracted here. I close my blinds. I always get hummingbirds that come around here all day flying in my window and stuff. And I always say to myself, oh, okay, they're just, go to the water fountain. They're not really trying to get my attention. I close these blinds because of the sun, and now I've got a hummingbird coming over here to this window, which they never do. So maybe they really do want to talk to me. Okay, anyway, so I get a little distracted. Why is that bird flying right there? Okay, sorry. So what happens? We're sitting here, and we have what? We have the specific line item like accounts receivable, and often an entity will get an audit like that just focuses on accounts receivable, because often a bank or somebody will base a loan on the integrity of the reporting of the accounts receivable, because accounts receivable will be used, that asset will be used to be repaying the loan balance at some point in time as they collect on that. Okay. All right. Now let's take a look at the audit procedures down here. Okay. And when auditing a single financial statement or a specific element, the auditor should perform procedures on any interrelated items. For example, if they're asking us about accounts receivable, we're probably going to have to do some work, looking at the sales account, because accounts receivable are generated by sales. Okay. Now you come over and let's take a look at some basically warnings up here at the top of the next page. These are sort of warnings. So let's just go ahead and look at this. And what if they ask you to audit stockholders' equity? Okay, just that part of the balance sheet. So what happens now? If that's the case, the auditor should perform procedures necessary to express an opinion about the balance sheet financial position because of the interrelationship between stockholder equity and the balance sheet accounts. So it's kind of a warning, because they're saying, look, if they start asking you to audit such a big chunk of a statement, it could then require that you have to go and do what? Audit the whole statement, because assets equal liabilities plus stockholders' equity. So how can you really say you're satisfied with stockholders' equity unless you've satisfied yourself to some extent as to the assets as to the liabilities? That sound you hear is you're auditing the entire balance sheet. Okay. What if they say, well, look, audit net income for us? Okay. Well, now they're asking you to do what? Pick up such a significant piece of the income statement that it is going to be necessary for you to audit the entire income statement, right? The revenue minus expenses is what generates net income. If you're going to give an opinion on net income, that sound you hear is what? You're auditing the entire income statement, and they're telling you now it's going to be the balance sheet and the income statement, because how can you audit the income statement unless you satisfied yourself as to amounts for assets and the depreciation on those assets, etc. Okay, so this is why I call it a warning. The standard is saying, if somebody asks you to audit a major chunk, like the results of operations, the income, net income, then you're going to have to turn around and tell them, hey, I got to audit the balance sheet and the income statement. Sorry. Okay. Okay, good. Now, when we determine materiality, we determine materiality as it relates to, and we're going to talk more about materiality in Audit 2, our next chapter. But for the materiality, you have to determine the materiality as it relates to the specific single financial statement line item, or as it relates to a specific particular account. Okay, so as a result, the audit of a specific element is usually more extensive if the same information would be considered in the audit of the complete financial statements. So when we talk about materiality, we say, well, what would be a fact that would be significant enough to change the decision of the user of the financial statements? And we often, well, we're required to come up with a dollar amount. So let's say we say that our materiality for the entire set of the financial statements is $1 million. Any misstatement in excess of $1 million is material because it could change the decision of a decision maker. But then when you sit there and you look at the financial statements, let's say accounts receivable is only 100,000. Well, if you set a materiality level at $1 million, your answer is going to be, well, I'm not going to even look at the accounts receivable because it's such a small chunk of the overall financial statement. So I'm going to do a limited amount of work there. But if your opinion is on accounts receivable, and that's what the person is basing their decision on, okay, and that amount is 100,000, well, then your materiality obviously is going to have to be a lot less than $1 million. It's going to have to be a lot less than 100,000, because you've got to try to find a material misstatement in just that line item that would be significant enough to change the decision that's being made to, say, give the person a loan or whatever, the company a loan based on the account receivable. Okay, so the smaller the piece you're auditing, the more your materiality levels start to shrink down. Okay, good. Let's come over and let's see what happens when we are auditing a complete set of financial statements and, say, a single financial statement or a specific element. Remember, we said in the beginning, you could be engaged to do both things, audit the complete set and audit a particular line item. So what we're going to see here is how the audit of the complete set of the financial statements will affect the audit of the line item, and more importantly for this chapter, the report on the specific line item. So let's take a look. When auditing a complete set of financial statements and a single item, the auditor should, okay, issue a separate report and express a separate opinion for each engagement. The reports may be published together. That means in the same document. So it's two separate reports, but we publish them together in the same document, saying annual report, provided that they are sufficiently differentiated so that people know which one is the report on the specific line item and which one is the report on the entire set of financial statements. And the report on the complete set of financial statements is unmodified. So flashcard that, okay? So what they're saying to you is, we don't want you to contain in the same document a qualification on the entire set of financial statements while issuing what? An unmodified opinion on the specific line item, let's say, because now you start to confuse the reader. So it's okay to go ahead and have different opinions on the consolidated versus, on the full set of financial statements versus this single line item, let's say, the specific line item, but you can't contain them in the same document, say an annual report or something. Okay, and then indicate the report on the specific element, the date of the auditor's report on the complete set of financial statements, and the nature of the opinion expressed. Okay, so if you were, say, giving an unmodified opinion on just accounts receivable, and meanwhile you had modified your opinion, let's say, on the complete set of financial statements, they would want you to call that out on your audit of the single set of financial statements, making sure that the users of your report are aware of what you're aware of, which is how did this fit into the overall audit that I completed on the overall set of financial statements. Okay, all right, good. Come over and let's take a look at the next page. And if the auditor's modified opinion on the complete set of financial statements is relevant to the audit of the specific line item, the auditor should do what? And this is one of the few times that the standards call out and tell you what kind of opinion to give on the financial statements when something happens. Generally, we say, hey, it's auditor's judgment to decide if it's qualified or adverse. Here, this is one of the few cases where the standards come in and say, if this happens, you will do this with your audit report. So let's just take a look. And they tell us, hey, don't even think about it. Express an adverse opinion on the specified element when the modified opinion on the complete set of financial statements is due to material misstatement of the financial statements. What? Let me read that again more carefully. Express an adverse opinion on the specific element, when the modified opinion on the complete set of financial statements is due to material misstatement of the, okay, I got to call in another edit here. They've got to mean the specific line item. Otherwise, that doesn't make any sense. Express an adverse opinion when the modified opinion on the complete set of financial statements is due to a material misstatement of the financial statements. Well, that's why you give a modified opinion, because there's a material misstatement in the financial statements. So what they mean to say here is that there has been a misstatement in, say, one of the financial statements or the line item, and that's what resulted in the modified opinion on the complete set of financial statements. For example, let's say I have to modify opinion because accounts receivable was materially misstated. So I give a qualified opinion, and in my reason for my qualification, I say there was a misstatement in accounts receivable, and that's the reason for my modification, right? Well, if that's the case, the standard is saying, say no more. You will give an adverse opinion on the specified line item, because they're saying if it was bad enough to result in a qualification on the overall financial statements, it's significant enough to automatically result in an adverse opinion on the specific line item. They tell us that we have to express a disclaimer of opinion on specific element when the modified opinion on the complete set of financial statements is due to a scope limitation, again, that is related to that specific line item. Okay, so flashcard that if you result in a modification on the complete set because of something that's going on with that specific line item, then you're going to do what? You're going to have to adverse if it's a gap reason. You're going to have to disclaim if it's a gas reason on the specified element. Okay. Okay, good. Come over piecemeal. Okay. When an auditor has an adverse or disclaimer of opinion on the complete set of financial statements, okay, then what happens? In this situation, the auditor considers appropriate to express an unmodified on the specific element. The auditor should only do so. So we've got what? We've got an adverse or disclaimer on the complete set, but we're saying that, hey, we were able to get enough information to allow us to give an opinion on, say, just accounts receivable. Now, again, this would be a situation where account receivable isn't what's driving a qualification or isn't what's driving the adverse, okay? The opinion on the specific element is not published with and does not accompany the auditor's report on the complete set of financial statements, and the specified element does not constitute a major portion of the entity's complete set of financial statements, okay? Now flashcard that, but let's talk about that for a second. So what they're saying here, you go and you disclaim an opinion, let's say, on the overall set of financial statements. And then in your reason for your disclaimer, you say, well, the reason I'm disclaiming is because I couldn't get a good opinion on accounts receivable. And then you turn around and you talk out of the other side and you say, and here's my unmodified opinion on accounts receivable. You're contradicting yourself. If the accounts receivable is significant enough to result in a disclaimer, how could you have possibly gotten enough evidence to give an element on the specified element account receivable? The other thing, number one, there is saying, and if you were in the situation where you had to disclaim, let's say, on the overall financial statements, but you were able to get enough evidence for accounts receivable, because obviously then accounts receivable didn't constitute a major portion of financial statements, do not contain them in the same document. Because again, we have the potential of confusing the reader. Over here, I see an opinion. Over here, I see a disclaimer. Okay, this opinion is good enough to override this disclaimer. We don't want them to get confused, so they would have to be in separate documents in that circumstance. Okay, question? Okay, good. And then coming down, an unmodified opinion, unqualified for a public company, should be expressed on a single financial statement if the auditor expressed, should not be expressed when the auditor has given an adverse opinion on the complete set of financial statements. Again, they're telling us don't contradict yourself. You give a disclaimer or adverse on a full set of financial statements, and then you go ahead and you give an opinion on the balance sheet. Meanwhile, the statements are interrelated. How is this happening? Okay, so you've got to be careful in how you put together the logic of these specific element or single financial statement reports. Okay, and then finally, emphasis of matter. If the auditor report on the complete set of financial statements includes an emphasis of matter, other matters, explanatory paragraph, when we're talking about public company, is relevant to the single item, then include that similar emphasis of matter, other matter, explanatory paragraph in your report on the specific line item. Okay. So not exactly something that someone's going to wake up in the morning and say, I remember those rules. Therefore, you can see that we flashcarded the hell out of that. And that tends to be the approach I take for stuff like this, that just nobody remembers this unless you put it on a flashcard and you got it there in front of you. Okay, so your best bet is to basically flashcard these 2 pages, is basically what we did here. Okay, question?
You said that that's going away after July. Do we need a flashcard? I'm still going to, but do we need a flashcard?
No, unless you got a flashcard fetish of some sort. No. Yeah, don't make them if you're going to take the exam after July, because it's going away.
Gotcha. That makes sense.
And it's one of the more difficult areas for me to teach. Therefore, it's probably one of the more difficult areas for you to understand and remember. So no, save that brain power for something else. Okay. All right, good. So if I didn't have folks in the class taking the exam in July, I wouldn't have even covered that.
Fair enough. I just thought I'd ask just in case.
Yeah, no, go for it. Okay. All right, good. Let's go ahead though. Let's take a look at this question. Okay, guys, let's go ahead and let's look at this one. And okay, decent turnout here. Maybe some of us are putting this one in our back pocket since you're saying, oh, I'm not going to take the exam for July, so I'm going to rest my eyes. So let's look at this one. And the correct answer is C. So most of us got it right. And Harris CPA has been asked to audit the report on the balance sheet, but not the statement of income, retained earnings, cash flow. The audit will be performed in conjunction with the audit of the complete set of the financial statements under these circumstances, and at no point to, okay, if you didn't submit the answer, I'm not sure why you weren't able to, unless I cut it off too early, but I gave about 2.5 minutes for that. You should be working questions about a clip of 1.5 minutes. C, accept the engagement because such engagements merely involve, well, let me back up. There's no reason that you couldn't accept engagement, right? We can accept engagements where we're just being asked to audit one of the financial statements as part of an audit of the complete set of financial statements. So not accept is A, that gets rid of A and B. Let's look at D. We know C is the right answer. Accept the engagement, but should disclaim an opinion. Well, what would be the point? Okay, if I accept the engagement just to disclaim, then why did I even bother? Accept the engagement because such engagement merely involves special considerations in the application of gas. I'm going to have to lower my materiality levels for that specific line item. I've got to make sure not to combine the reports. All of those things that we flashcarded are those special considerations. Okay. All right, good. Let's go ahead and let's take a look at the next module. Okay, and let's take a look at subsequent events. So what happens here? I have a specific date for the financial statements, say 12/31, 2021. Okay, so that's the date on the financial statements. That's the company's year end, right? But of course, I'm going to have to do some audit work before I can issue the opinion. So let's say that we don't get around to actually issuing the audit report until February 15th. And for public companies, it's very specifically legislated as to how much time they have to issue the statements and stuff, okay, and SEC rules and whatnot. But whatever, let's say I don't issue the report until 2/15/2021. Well, that period in between is called the subsequent event period. And subsequent event means things that happen after the date of the financial statements, but what, or discovered after the date of financial statements, but not what, but after the date of financial statements, but before the report is actually issued. So the auditor has responsibility for this period. I don't know where I want to write that. The auditor has responsibility during this period to remain alert for things that maybe happened or were discovered after the balance sheet date and happened before the issuance of the report. For example, let's say that we have a situation where we have a client and the client has their year end December 31st, and then there's an accident and one of their factories is destroyed in January of that next year, January. So December 31st, 2021, accident happens in January 15th, 2022. And the financial statements are going to be issued February 15th, 2021. The auditor is responsible to make sure that a situation like that is properly disclosed in the financial statements. You're saying, but John, the date of the financial statements is 12/31/2021. Yeah, but we haven't issued the statements yet. We haven't issued the report yet. And so the standards say, hey, remain vigilant, auditor, for things that happened during that period and make sure they are properly either reported in the financial statements or in that example, disclosed. Okay. Now in the notes of the financial statements. So when something is recognized in the financial statements, there literally will be a debit and a credit put into the financial statements for something like that. Okay. And the classic example of recognized subsequent events is settlement of litigation. Okay. So what happens here? Well, let's say there was a lawsuit that our client was undergoing, and that was ongoing at December 31st, and it hadn't been resolved yet. And then on January 15th, there's a settlement, and the company loses that lawsuit. Well, the standards say since that lawsuit was already underway during the year, okay, it was already underway at December 31st, you are required before you issue the financial statements to debit a loss and credit a contingent liability. You literally need to record that, recognize that in the financial statements, because they're saying, hey, that maybe wasn't initially there at December 31st, but the progress was underway. And so we're going to make you record that, okay? The other classic example is loss on an uncollectible receivable. So what happens here? Well, we had a receivable that was sitting there, and our client's customer declared bankruptcy at December 15th, but our client didn't know about that until, say, January 15th. Well, what happened? Well, what's giving rise to the problem here already existed at December 15th before the end of the year. So the expectation would be that the client will do what? Debit the allowance for doubtful accounts, credit the account receivable. When they debit the allowance for doubtful accounts, the balance in the allowance account will go down. They may now want to put more in the allowance account, so they'd have to debit bad debt expense and credit the allowance. Okay, don't worry if you're not tracking the accounting there entirely. It's resulting in journal entries. It has to be recognized because the client's customer had already gone bankrupt before December 31st. With me so far?
Yes.
Now, go ahead.
For your example, the financial statement date should be 2020 or?
Oh, yes, sorry. Well, I meant for this to be 2022. Thank you.
Okay.
Yeah, it'd be the next year. Thank you. Okay.
What if they went bankrupt on January 1st? Since it's a subsequent event, would you still have to make an entry for that? Or what if they didn't find out? What if they went bankrupt on 12/31, but they didn't find out until, the beginning of January?
Well, those are two different questions as to how I'm going to answer that. The effect on the financial statements is the same, but how I'm going to answer it differs. If they went bankrupt on December 31st and we find out about it on January 15th, that's no different from what I just told you. December 15th, it happened what? Before or on the year end, right?
Right.
Okay, so that's no different from what I said. Now, if they declared bankruptcy on, let's say, let's go a little beyond your question, say January 15th, they declared bankruptcy. The standards say that is a recognized subsequent event. You're saying, well, wait a minute, John, but it happened in here in a subsequent period. It's kind of like the factory blowing up thing. Maybe it should only be disclosed. No, because the standards have called that out specifically and said the events that gave rise to that bankruptcy, companies just don't say, hey, everything's great. Oh, I'm bankrupt. They were in the process of going bankrupt before the year ended. And so it is a recognized subsequent event. And then the accounting goes back to what I've already said. So you got to be careful with that one, because they'll say it was discovered in the subsequent period for a bankruptcy type thing, but the companies don't go bankrupt overnight. The events that led to the bankruptcy were already underway before the balance sheet date, right? That's different than a plant blowing up. I mean, plants don't blow up slowly. Okay, first there's a plant there, and then boom, the thing blows up, and it happens, you know, in January. That's still something that the auditor has a responsibility for, but now we're not expecting the client to debit loss credit factory. It's a non-recognized subsequent event, okay? And for a non-recognized subsequent event, right here, subsequent that provide information about conditions that occurred after the balance sheet, but did not exist at the balance sheet date, and they are not recognized. So no JE, no journal entry of that, but what? But disclose. Okay. Now, does this make you nervous as a CPA? That's a question.
Yes.
Yeah, this is one of those things that makes you, maybe I want to be a CPA, because what happens? I've got these little financial statements here, and then I got a whole world that just won't stop while I'm trying to complete this audit. Okay, so it makes you a little nervous, and you're going to say, well, how am I going to cover myself for all this stuff that, you know, damn world won't stop while I'm trying to complete the audit? You know, that's why sometimes I watch the news and it starts to freak me out, all the things that are going on. And I'm like, well, you know, this is now the news reporting to you everything that's going on. It is a spinning world after all, and stuff is going to happen during the day. And then it's their job to figure out what they want to tell you about, right? So anyway, so what happens? You come over and let's take a look at what we're going to have to do. And we are going to be responsible, public companies and other entities that intend to widely distribute their financial statements, okay, all are required through the date of the issuance. All other entities must evaluate through the date the statements are available to be issued. Just flashcard that. I mean, that's one of those things that I could see the damn examiners writing a question on just because it's easy to write a question about something like that, but not a big deal. Okay. Then what? What happens if statements are reissued? So what happens? The statements get issued in our example of, you know, after, let's say they reissue the statements, and let's say they reissue the statements on 3/15, or let's make it 5/15 just to make it, you know, out there a little bit. 22. Is the auditor responsible now to open up another area of responsibility for subsequent events between the original date of the issue and the reissue date? Okay, and that's going to be answered right here. When an entity reissues financial statements, the entity should not recognize events that occurred between the date of the original, in our example, what, 2/15, and the date that the financial statements were reissued. In our example, what I said, May 15th. Okay. Again, non-recognized subsequent events have to be disclosed. Okay, you got to disclose those. All right. Okay, now come down, and again, owner was saying, yeah, I'm nervous. How am I going to cover myself about all those subsequent events? And the standards have given us a set of things we should do to protect ourselves against these subsequent events. So if something out there happens and it should have been recorded or disclosed, and you can prove to somebody that's looking at you, well, look, I did these procedures. Remember, it's reasonable assurance that I'm providing, not absolute. But if you sit there and say, well, I did nothing to cover myself during that subsequent period, well, no one's going to have any sympathy on you. If you can meticulously, professionally show, well, look, I took these steps and I've never claimed to be infallible. I said that I'm giving reasonable assurance, then you've got some protection there, right? So what do? You look at transactions that happen after the balance sheet date. So you look at transactions that are being recorded in January, and all of a sudden you see this huge, payment going out in settlement of litigation in January. And you say, excuse me, what was this for? Oh, we didn't mention to you that we settled a lawsuit, and we knew that back in December or something, that we knew that we had that lawsuit, and we knew that we settled it in January, and we didn't tell you. So you would find that way. Okay. Representation letter. What happens? We're going to talk later about the representation letter, but a management rep letter comes at the end of the engagement. And what we do in that engagement letter is we start telling management to let us know about scary things. So subsequent event, I'm having trouble remembering letters today. I'm a terrible speller anyway. Subsequent event is included in that management rep letter. And in the management rep letter, we say, you told us about all the subsequent events, right? And we make them put down in writing and sign in a letter to us that they told us about all the subsequent events. So if you wind up that there was a subsequent event and you didn't find that subsequent event, and then what? You can go to court and you can show, well, wait a minute, or you're being reviewed by somebody and say, well, wait a minute, management knew about this. They put in a letter, an assigned letter to us that they had told us about all subsequent events. Meanwhile, there was something out there that they didn't tell us about. So again, we start covering ourselves for that sort of scary period between the end of the date of the financial statements and the date the statements are issued. We ask them about things. Any events out there? Oh, really? A plant blew up. Okay. Minutes to stockholders meetings. One time I was looking at not stockholders, but board of directors meeting minutes. And all of a sudden they got cute and they started saying the suit, this, the implications of the suit. And I went back and I'm like, what are you guys talking about? Somebody's suit here? What suit? What does this mean? And it turned out that they had been sued by an employee and they hadn't told me anything about that. And then I kind of picked up on it by reading the board of directors minutes, and come to find out they had to book a contingent liability for this lawsuit that employee was running them through. Okay. And then if there are interim statements, because interim statements, may be being generated already while you're trying to finish up the 12/31 year audit. And if they're starting to put things together and pull things together into those, you can look at them, even if they're not completely issued yet, you can still start to look at what's being listed there. And all of a sudden you see disclosure in the interim statements and you're like, why is this not in the year-end statements? Because it's a subsequent event that's happened already that should be disclosed in year-end. Okay, so you do these things, and this is one of the few times I do like Becker mnemonics when it's just a word that I have to remember. For my subsequent events, I just remember the word prime. That helps me remember the type of procedures that would cover me for subsequent event. Okay, question. All right, so what happens? You do all that, and then you find out after the reports have been issued. Well, let me stop. I'm jumping a little bit too far ahead. So let's say you find out that there's something that should be disclosed in the financial statements that is not. What are you going to do?
Ask management about it, why it wasn't disclosed, if they were aware of it, that kind of conversation.
Okay, so there's something that should be disclosed. We haven't issued the statements yet. You ask them why it's not supposed to be disclosed, and they say, or you ask them why they didn't disclose it, and they say, oh yeah, it should be disclosed. So what are you going to ask them to do?
Go and disclose it.
Good. Okay. Excellent. Yeah, that's all I'm saying. Okay. So the auditor has no active responsibility to make inquiries or procedures after the original date of the auditor's report, except as described in the chart below. Go ahead and flashcard those guys. I don't care, but there's an off chance that they might ask that. I'm not getting into these minutiae here. Go ahead and flashcard that these are instances where there'd be an exception. Okay. But come over here and this is the key point here, this blue. However, if the auditor becomes aware of information relating to subsequent events before the report release date, the auditor should consider whether it's necessary to adjust the financial statements or the related disclosures. Okay, so you're going to ask them to do what? You're going to ask them, as it was indicated, I don't know who exactly said that, you would ask them to do what? Disclose it. Okay, so if there's something that has happened after the financial statement, the date of my report, but before the statements are actually issued, we'd ask them to do what? We'd ask them to include that in the financial statements. Okay, now the other consideration is what happens if the statements hit the streets and now the auditor determines, hey, after issuance, something should have been in the financial statements. What would you do at that point? Amr, are you getting more nervous?
Very nervous.
Okay, because now what? Now stuff is happening. I won't use the other word. Out there, your report's already on the street and you're sitting there saying, they should have disclosed that. Okay, so what are you going to do? If that's the case, then the auditor will take action. Okay, and the auditor will determine if it's significant and there's persons relying on the financial statements. And if that's the case, flashcard, advise the client to issue revised financial statements, advise the client to make necessary disclosures. Okay, they're mixing themselves here a little bit here, guys. First they say after issuance, and then they say ask them to fix it if the statements haven't been issued. So they obviously weren't concentrating when they wrote up this paragraph. So if the statements haven't been issued yet, then go ahead and say, hey, include that information. Okay. If the effect on the financial statements cannot be determined, now this is getting back to the statements being relied on, so that means they're already out there, then the client should be advised to discuss with the SEC, regulatory authorities, etc., what the new disclosures are. Okay. Okay, good. Now you come down and that's the auditor action if the statements have already hit the streets, although that second one, they're saying if they haven't issued them yet. But now you come over and let's say there's a subsequent event that happens before you issue the financial statements. You have dated your report was ready to go out. Your report was ready to go out. What did we say? February 15th. That was going to be the date of your report. And your statements are ready to be, the statements are ready to be issued. Your report's ready to be issued. And then management calls you on February 18th and says, guess what? A plant blew up last night and we haven't issued the statements yet, and we need to disclose that. We need you to come and look at that information, and we're going to need you to change the date of your report from February 15th to February 18th. Now, what happens? If you just go in and erase the old date and put in the new date, not only are you accepting responsibility for the disclosure of that plant blowing up, but anything else that might have happened between the 15th and the 18th that you are not being informed about. So you would turn to your client and you would say, well, I can do that. I can change the date, but if I do, I'm going to have to go back through another prime review to make sure that there's nothing else. And the client's going to say, no, we don't have time for that. We have to issue. What do? What you do is you dual date the report. You dual date the report to extend responsibility only for that particular subsequent event. So your report would say, hey, the date of my report is, now this example, January 21st. In our example, if I can remember the dates now, the date of my report is February 15th, except for footnote 2, where the date of the report is February 18th, because I've seen that the information about the plant blowing up on the 18th is properly disclosed, whatever. Okay.
I have a quick question.
Mm-hmm.
Is there like a reasonable amount of time? Like your example was like 15th to the 18th, which is only a few days, but is there like a certain cutoff where like a week or 2 weeks where it's just like it's not like it's too much to include it because you're already like reporting it? I mean,
Before the report is issued?
yeah, I mean, like if your date is the 15th and like let's say something happens like 2 weeks later, but your report's already out, I mean, what do you?
Wait, stop. If the report is already out, then the subsequent period has ended.
Okay.
So I don't have to worry about that. That's going to have to be in next year's financial statements if the report is already out.
Okay.
Okay.
For example, we use February 15th as the date to issue the report, correct? Or
Yeah.
and
You said the statements are already issued, so I'm having a little trouble. The statements are issued, say, February 15th.
uh-huh.
And something happens February 18th.
Right.
Too bad.
Okay. Never mind. I get it now. Sorry.
Yeah. Now, if it's something that had already occurred before the 15th and it didn't get into the report, yes, I do have a responsibility. But if it's something that happens after I issued the report,
Okay.
I don't have any responsibility for that.
Okay, got it.
So that's why they say, hey, you've got to remain vigilant up to that date. You do that prime review, and then you're responsible up to that date. Now, if something comes to your attention, that means, you're probably going to be hearing about it. And now you're like, hey, that should have been in the financial statements. Now you're going to ask them to do what? Reissue the financial statements to include that particular thing, whatever it was.
And then you would use the dual dating in order to like avoid having to be responsible for any other subsequent events.
In that scenario, what's happened is you were already probably ready to issue. You had the date of the report February 15th. And then before the statements were issued, they said, oh, we haven't had a chance to issue the statements yet. And now something happened.
Right.
They disclosed that. If you just change the date to February 18th at that point, you would have a problem because there's other stuff that could have happened between the 15th and the 18th that you didn't do the work for.
Yeah.
To see if you didn't do the prime to protect yourself against that, then you do the dual date.
Dual dating. Okay, cool. Okay, I got it. Thank you.
Mhm. Now, let's say you find some problems, okay, and the client refuses to do those things. They refuse to do the advise to reissue the financial statements, make the necessary disclosures, talk to the SEC, and they refuse to do those procedures. The first thing you do is notify each member of the board of directors of such refusal. Okay, now this is a prayer that the corporate governance structure is working. Okay, we're hoping that the board of directors will be smart enough to understand what's going on and compel management to do what they're supposed to do in this circumstance. Sometimes you run into a board of directors that just doesn't get it. Okay, and if that's the case, that should be less the case for a public company, but maybe with a non-public company, you're dealing with, those charged with governance that aren't as savvy. I had an engagement one time where they were supposed to approve anytime the entity liquidated the T-bills they had. And when I tried to talk to the board of directors to say, did you approve it? The person I spoke to, who was supposed to be the financially savvy person, didn't even know what a T-bill was. And so, what's a T-bill? Okay. So, if you run into a board of directors that isn't sophisticated, sometimes your reliance on the corporate governance structure is going to be, pretty difficult. Okay. So if they still refuse, okay, then you have to notify the client that you are no longer wanting to be associated with the financial statements, notify any regulatory agencies, notify persons that may be relying on those financial statements, and the notification has to be sufficient. So if it's one user, it's a conversation with that user. It's probably a sit down meeting with that user. If there's hundreds of thousands, millions of users, you're probably taking out some sort of ad in the financial presses or something, but you'd have to let them know there's something that should have been disclosed in those statements that I've become aware of. You ask them to fix it, like we talked about on the previous page, but if they refuse, you try to get the board of directors to do their job. And if they don't, then you got to start going outside the entity and notifying people about that. Question? Okay, good. Flashcard, the procedures here when the client won't do what they're supposed to do. And let's go ahead and look at a multiple choice question, and we're a little late for the break, so we'll take a break after this question. Okay, guys, go ahead and take your selection. Okay, and so I think this is the first time we got 100% on something. Okay, so that's good. Got 100%. Okay, and of the 13 people that are participating in this group, 10 of us made a choice and got it right. As of August 13th, a CPA had obtained sufficient appropriate evidence. I'll move it out of the way so when we see the recording, you can see that. Okay. As of August 13th, the CPA had obtained sufficient appropriate evidence with respect to fieldwork on an engagement, the audit financial statements for the year ended June 30th. On August 27th, an event came to the CPA's attention. They always write it that way. Probably management's the ones that told them about it. Came to the CPA's attention that should be disclosed in the notes of the financial statement. The event was properly disclosed by the entity, but the CPA decided not to dual date the report. They just changed the date to August 27th. If that's the case, they've taken responsibility for what? Everything that could have happened between the 13th and the 27th. So you would want to dual date the report. August 13th, except for this one thing, it's August 27th. Okay. All right, good. So before we go to break, let me go ahead and ask Matthew, did you have any questions about that one?
No.
Cornelius? Cornelius?
Oh, I'm sorry. No, I didn't.
Okay. Joseph?
Nope, no questions.
Amara?
No questions.
Kristen?
All good here.
Okay. Monica?
No questions.
Raphael?
No question.
Travis?
No questions?
Julia?
No questions.
Okay.
No.
And?
No, I don't have question.
Okay. So who are the people that aren't answering the question? We're here to read through these questions and take our best shot. Put in the work. Put in the work to see that you're understanding the material and you're able to answer the question. Put in the work. You got to do it this way. If you don't do it this way, I promise you, you probably won't even end up taking the exam because you're just going to say, I'm frustrated. I don't understand what's going on. Let me decide not to be a CPA. You're here, you're spending the time with me here on a beautiful, it's a little windy, but whatever, a beautiful Thursday evening. You're alive, you're young, you're spending the time doing this. Do the program. Okay? All right, guys, I will see you in about 10 minutes. So let's make it 7 o'clock, okay? Okay, guys, we're going to go ahead and get started back. I guess there still seems to be some confusion about the way this program is working here at Golden Gate. So let me go back over some things that I thought I talked about in the introduction class, but maybe not. So let me make it clear that here at Golden Gate, they charge you a $1,400 materials fee. That materials fee gives you access, lifetime access to Becker for all 4 parts of the exam. All 4 parts of the exam. So obviously you're getting access to auditing because you've signed up for this class. If you, for some reason, decided, hey, I just want to take auditing, but I'm not going to take BEC, I think is the next class, 379, you still have access to all 4 parts of the Becker material for that $1,400 materials fee. You, of course, wouldn't be able to be involved in the lectures unless you signed up and paid the tuition, which is $500 per unit, well, $515 or something like that per unit in the actual class, but they don't turn off your access to Becker. You still have access to Becker for all 4 parts, lifetime access. Okay. So at this point, I know that one student has received the email yet from Becker to activate your account so you can do your homework. And I'm looking into that. It's a later added person. So I think they have to make sure and continue to communicate to Becker to add a person's account even after the class starts. And sometimes they forget to do that. So I'm going to remind them of that. But you get all 4 parts lifetime access to Becker by taking one of the 4 CPA applied classes, 377, 378, 379, this class 380. Okay. Does that answer any questions on that?
Well, that answered the question I had about the access, but yeah.
I'm sorry?
That answered the question I had about the access.
Okay. Okay, good. Yeah, and we'll look into Cornelius, what's going on. I think because I think they added you a little later, right?
Yes, sir.
Yeah, so you know, I think you get lost in the shuffle a little bit when that happens, and so I'll remind them. That's why I keep asking, if you don't have access yet, tell me what you have. That's great, and I'll push them again to get them to get you that access. So that should happen pretty quickly. Okay. And then, of course, if you already had the material and you brought it to this class, you don't have to repay for it. So make sure they don't charge you for the materials fee if you, say, through your employer already had the materials. I think there was only a couple of people that fell into that situation. Okay. All right, good. Let's go ahead then, if there's no questions on that kind of thing, and let's start to take a look at what happens with other supplementary information and other information. Okay, so of course, we're talking about the financial statements, and we've been talking quite a bit about the auditor's opinion, which covers the financial statements. Now, what happens? Well, and I mentioned this a little bit, I don't know if it was the last time or the time before that, there are other pieces of information that could contain the financial statements, such as an annual report. And I'm sure you've seen this. Companies do what? They take their annual report and they stick them, they take the financial statements and they stick them into the middle that says annual report. You could also have supplementary information. Okay, supplementary information. And with the supplementary information, it's not considered part of the financial statements. It's there to supplement the financial statements. And often standard setters will say, hey, not only do you have to provide the financial statements, but you have to supplement it with this additional information. But the engagement generally only covers the financial statement and not the supplementary information. So what we're going to start to understand here is, what is the auditor's responsibility as it relates to supplementary information? What is the auditor's responsibility as it relates to the annual report when the financial statements is contained inside of the annual report? Okay, so they start to give us some examples of supplementary other information. For example, you know, financial ratios, whatever, a bunch of different stuff, okay? Now, we come over and we say, well, what is the auditor's responsibility? And generally, the auditor is not responsible to determine if other information containing the audited financial statements and the auditor's report is properly stated. And essentially, that is talking about, you know, they're kind of being a little bit, you know, you can say vague or general. They're talking about the annual report. Okay. However, the auditor should read the other information, the audit report, because the credibility of the audit financial statements may be undermined if there's a material inconsistency between the audit financial statements and the other information. So you can't just ignore entirely, even though your responsibility doesn't extend to that annual report necessarily, you just can't be completely blind about it. You have to read it, and you have to look to see if there is a material inconsistency. So if the auditor identifies a material inconsistency, then you should ask that either the financial statements or the other information be appropriately revised. Let me give us an example here. Material inconsistency, annual report says one amount for revenue. Meanwhile, you've audited the financial statements and you're pretty secure that the financial statement is correct, that the revenue is fairly stated there. So what are you going to do? You're going to ask them to fix the annual report. Okay. Now, of course, if the financial statements are wrong, then you will go ahead and ask them to fix the financial statements. And if they don't, then you're going to have to give a qualified or adverse opinion. Okay. But we're going to assume that what, you know, probably more likely the situation is what? That the other information, the annual report, for example, needs to be revised. So if the other information requires revision and management refuses to make the revision, you've got some options, okay, at that point. And we talked about this back on the page 55. Let me just tell you, see page 55, but we talked about this, you know, a while back. Add a what? Add another matters paragraph that says, hey, look out, reader of my audit report. There's something wrong in this annual report. You know, and you probably got to my report while you were inside of the annual report. I'm telling you, there's something wrong in the annual report, and you should take a look at that. You may be so concerned of that you decide to say, hey, I'm not going to let you use my audit report unless you fix what's in the annual report. You could withdraw from the engagement. Okay. I would think, you know, you're probably heading towards, if it's me, I'm doing those last two bullets. I'm telling them, look, fix it. What's the problem? You got it wrong in the annual report. What are you trying to do here? I'm probably withdrawing or withholding use of the report if they don't fix it. But, you know, probably questions on the CPA exam dealing with the report are going to focus on an auditor doing this. I'm thinking I'm asking them to fix that, okay, that material inconsistency, okay? Now, coming down, the auditor is not required to reference the other information in the audit report. However, the auditor may choose to include another matters paragraph disclaiming an opinion on that other information. So you may or may not do that, but flashcard that. Okay, you could decide to add other matters talking about the other information. Okay, okay, good. Now that whole discussion really deals with the outside box there, the annual report. Okay, let's take a look on reporting on supplementary information. So let's go back to my genius drawing over here. That's going to be this stuff right here. Okay, so let's see what they expect us to do with that other information. And notice it's getting closer to the financial statements and to the auditor opinion. So it shouldn't be surprising that they're going to start to talk about how we could be involved in that supplementary information. Okay, so they tell us that supplementary information is presented outside of the financial statements. Okay, but it is what? It is separate from the financial statements. Now, the client may say, excuse me, auditor, you busy? Can I call you in my office? Yeah. We know that your opinion doesn't cover the supplementary information. but we'd like to get an opinion on that supplementary information. What are you going to say to them? That's a question. Usually sentences that I give you that start with the word what tend to be a question. I'll wait.
I'd say you can go ahead and take the engagement. There's nothing against that, I don't think.
Huh?
I would think you're able to go and do that, but you would have to, I don't know if you put it in a different area of the report or something.
I'd have to get some money from them, first of all. First thing I'm doing is saying, okay, well, we'll work up a fee schedule. We can do that, but we're going to have to work up a fee schedule for that, right? Okay, so it's a chance to make some more money. So you're probably going to say, okay, yeah, I can do that. Okay, so the key thing, and thank you, Matthew, and I'm sorry that it always falls on you to carry the burden for the entire class, but you're probably getting a heck of a lot more out of this discussion by doing that work. So I appreciate that. Okay. The auditor may be engaged to report on the supplementary information related to financial statements. May. You don't have to. Okay. Now you have two engagements, two objectives, I should say, if you choose to be involved in that engagement. And you're going to evaluate the presentation and information in relation to the financial statements taken as a whole. So what? You've audited the financial statements, the information is there to supplement it. So you're going to evaluate it into how it relates to the financial statements. And then you are to report on what? On whether the supplementary information is fairly stated, again, in relation to financial statements as a whole. And the reason I keep underscoring that phrase is because that's where what I see in a lot of the questions. What are you required to do? And it's always, how does it relate to the financial statements as a whole? Okay, so flashcard that. Okay, and then let's go ahead and take a look at what are the conditions to be able to give an opinion on the supplementary information. And again, you can do that, but you have to meet the requirements that are being called out here. Okay, so you have to see that the information was derived from the financial statements. So they're saying, hey, you audited the financials, so the information should be derived from the financial statements. It's the same period as the financial statements. You audited the financial statements, okay? Neither an adverse or disclaimer. Again, garbage in, garbage out. If you're deriving the information from financial statements and you gave an adverse or disclaimer on the financial statements, forget about it. Don't sit there and start trying to say that you're going to be able to give an opinion on the supplementary information, and the supplementary information will accompany these statements or will be made readily available by the entity. Okay. All right. Flashcard then. Okay. Let's take a look at management's responsibility as it relates to that information, and they have to prepare it. And we're going to get written representations from them about the supplementary information. Again, we're going to talk about management representation letter later, but you have to get a management representation letter on an engagement where you're auditing financial statements. They're saying to us, okay, if you're going to give an opinion on the supplementary information, you have to get an engagement, a management rep letter for that. Okay. Okay, good. Audit procedures. What are the procedures that I'm going to have to perform to support this opinion now on the supplementary information? Okay, and so you're going to use the same level of materiality, and then you're going to start to do some procedures, inquire of management about the supplementary information, determine how that information is supposed to be looked at. Again, the standard setters, like the Governmental Accounting Standards Board, will tell entities, this is how we want you to provide that supplementary information. And if you're going to be giving an opinion on that supplementary information, you're going to have to understand the requirements around that. Obtain an understanding of management's process for preparing that information. Compare and reconcile it to the audited financial statements, because again, you're going to be seeing that how it relates to financial statements as a whole. What are the underlying assumptions for this supplementary information? Evaluate the appropriateness and completeness of the information. And again, we said management has to give you the rep letter, and so you have to, of course, obtain the rep letter. Okay, flashcard that. Okay, good. Come over and let's take a look at the reporting requirements around the supplementary information, and let's look at it for non-issuers, I should say. And the audit report on the supplementary information may either be presented as an other matters paragraph in the auditor's report or in a separate report. Okay, so you write your report on the financial statements, your opinion on the financial statements, then you add other matters, and then other matters will give an opinion on the supplementary information. Okay, so you can go ahead and flashcard that. And we had a list of when you're supposed to provide other matters on other pages in the book previously. So remember I told you, hey, we'll talk in more detail as to how you end up having to put in other matters when you're going beyond just the financial statement audit. And one of those is if you're providing an opinion on supplementary information. Okay, so you could just put it as an other matters paragraph. You can see an example there, or you could go to a separate report, and the separate report will basically sit there and give an opinion in the separate report on the supplementary information. But it's important in that separate report that you put back to your opinion on the financial statements, because we're sort of deriving everything off of our audit of the financial statements. If there is a material misstatement, okay, then what? Then, of course, management doesn't fix it. Modify the opinion, qualified or adverse. If a separate report is being issued on supplementary information, withhold the report. Okay, you can flashcard that. Okay, okay, good. Now, effects on modifications to the report of the financial statements, and just come down here. The audit reports and the audit financial statements contain an adverse disclaimer of opinion, and the auditor has been engaged in reporting supplementary information. The auditor is prohibited from expressing an opinion on the supplementary information. I think we already said that, but make sure you've got that somewhere in your flashcards. Again, you're deriving the information from the financial statements. If there's a problem with the financial statements, right, as I said a minute ago, garbage in, garbage out, you're not going to be able to render any kind of report on the supplementary information. Okay, now that's if you were engaged specifically, okay, to give an opinion on that required supplemental information. Now, I feel like the book has this a little bit backwards, because they probably should have talked first about the situation here, which is, well, what is your responsibility for that supplementary information, even if you're not giving an opinion on it? Remember, it's right there next to the financial statements. When we were talking about the annual report, which was out here, you had to look at it for material inconsistency. So even if I'm not giving an opinion on supplementary information, because I'm not required to, do I have some responsibility with that? Okay, and the answer is yes. Okay, notice that what supplementary information, put it here, supplementary information, basic financial statements, in the absence of a separate requirement particular to the engagement, the auditor's opinion on the financial statement does not cover the required supplemental information, right? We just have the opinion in my little picture on the financial statements. But what are the required procedures related to the supplementary information? We have to inquire of management. What are the methods to prepare that supplementary information? This is even if you're not giving an opinion on it. You still have some limited procedures you have to perform. In fact, why don't we put that word, they're calling it required procedures, but you could also say it's limited in that you are really just looking at it, doing a sanity check on it, just like when you read through the annual report, okay? Determine if the supplementary information is consistent with management's responses And yes, you still want the engagement letter, not engagement letter, but representation letter to include discussion of the responsibility for that management has for the supplementary information. Okay. Now, reporting on supplementary information, other matters paragraph required, and let's take a look. The audit report for non-issuance financial statements should include an other matters paragraph with information that'll explain the circumstances. The required supplementary information is included. The required supplementary information is omitted, okay? And it can't be both. It has to be one or the other. But what they're saying to you here is you must acknowledge that supplementary information. So if you have a client that they're required to provide that supplementary information, even though your opinion, you're not giving an opinion on it, but in another matters paragraph, you're saying it's there. And if it's not there, you're saying it's not there. Okay, so you have to go ahead and at least acknowledge it. Okay, okay, good. Let's come over to the next page. And all we're saying here is, hey, look, an opinion is permitted, and we already saw that. So that's why I said they got this a little backwards. Why didn't they tell us the case where you're not going to give an opinion and how your responsibility for the supplemental information relates to all the financial statements, and then say opinion is permitted, and then tell us what we have to do to give the opinion. Instead, they told us what we have to do to give the opinion, and then they tell us what we have to do just generally related to financial statements, and then they tell the opinion is permitted. I don't get the order that they discussed this, but I used to first make you look at this and then go back to that, but then I realized everyone loses themselves turning pages, so I just went with the order of the book, but it's kind of a weird sequencing of the information. Okay, good. All right, let's go ahead then and let's look at this question.
I think I accidentally hit the wrong answer.
Okay, I won't kill you. I don't think you did.
Oh, okay. No, I know. Well, I'll tell you after.
Say it again.
No, I'll tell you what I was trying to hit after if I accidentally hit the other answer.
Okay, let's give folks a few more seconds and then we'll talk about it. Okay, guys, let's go ahead and let's look at this one. And everyone got it right. That's good. Hopefully you're not looking up the answers in the software just to shut me up. Okay, you should be trying to do these. Okay, and let's look at this one. And the answer is B. And notice here that the auditor of a non-issuer in an audit of a non-issuer, what is the auditor's responsibility for supplementary information, such as disclosures of pension information, we're outside the basic requirements required by GASB, and they're calling out GASB here because GASB requires a lot of things of state and local governments. And the auditor should do substantive tests. No, we're not going to test the data when we are simply doing a straight audit of the financial statements that contain supplementary information. The auditor should apply certain, and I even had to put in the word limited procedures, and add an other matters paragraph to the auditor's report, right? That's what we're required to do. Limited procedures, acknowledge that the information is there, right? C, the auditor's only responsibility for the supplementary information is to determine that such information has not been omitted. What does that mean? Not been omitted. If it's not been omitted, I guess that means that it's been included. I don't even know what C is trying to say, but that's not our only responsibility. We have to inquire of management about it, look to see that it's there, and make some inquiries about it, right? Okay. And then D, the auditor has no responsibility. Yes, I do. I have to make some inquiries about it. This looks like a question written by Becker that has not been omitted. That doesn't sound like the examiners, that was a question that was released. Okay. Question? Okay, good. Let's take a look at module 12 now. And I'm starting to be overcome by the sense that we are just going to get through chapter 1 tonight and pick up chapter 2 on Monday. Okay, but I definitely want to get through chapter 1 so you can at least complete the homework over the weekend for chapter 1. I am working with Becker to get access so I can check to see if you're doing your homework. So don't fall behind that 8 ball. Okay. So, but let's go ahead and let's at least finish up chapter 1 and let's look at this module 12 now. So what's going to happen? Well, now we're going to get into the conversation of what happens if an entity prepares the financial statements and they want an opinion on the financial statements, but they didn't follow generally accepted accounting principles to prepare the statements. Okay. Well, if that's the case, then they probably did what? They probably followed another basis, and we can give the opinion, but the opinion will say they followed, and you can see these different bases here. They followed the cash basis, tax basis. Regulatory basis is, for example, I'm an insurance company and I'm being regulated by, say, the California Department of Insurance. Almost every state has a Department of Insurance. And what happens is, at least I know in California, the Department of Insurance requires, and this is probably the case in all 50 states, the insurance commissioners, insurance regulators require that companies issue financial statements that are available for review by the public, but they follow statutory accounting practices. And the Department of Insurance, National Association of Insurance Commissioners, says, for example, well, we don't want insurance companies like a life insurance company to capitalize office equipment because it makes them look like they're in a better financial position. Meanwhile, it's pretty difficult to liquidate office equipment and turn it into cash, right? So they make them follow certain rules and leave off certain assets, et cetera, when they're preparing their financial statements that get included in filings with the state insurance commissioners. So that would be an example of a regulatory basis. Contractual basis, basically, you and I have a contract, and I want you to present information to me under that contract, financial statement information, and we agree as to the type of basis of accounting that will be used. That would be a contractual basis, example, contractual basis. Okay, so what happens when you're asked to come in and you're auditing, say, a mom and pop, and they prepare their financial statements under the cash basis, and you want to give an opinion on that? Okay, what's going to happen? Well, let's stop for a go past this table. I'm going to come back to this table in a second. But I want to come over and let's first take a look at just some very basic things that'll happen. Okay, so we are going to prepare our report similarly to how you have described, but notice that you cannot use the gap titles. Terms such as balance sheet, statement of financial position, statement of cash flows are generally understood to apply only to financial statements that are intended to be in accordance with GAAP. So when you write the report, remember you say we audited the balance sheet, statement of operations. Remember, that's the way the report was written. If it is not GAAP, it's some other basis of accounting like cash basis, then you start getting wordy. Balance sheet, cash basis, statement of assets and liabilities, cash basis, statement of revenues collected and expenses paid, cash basis. But you can't call it the income statement. You can't call it the statement of operations. Okay, if it's a regulatory basis, call out regulatory basis, whatever. Okay, now you come over back to this chart. Okay, let's just come back to this chart. And there's a lot of information here, but when I look at this chart, I'm like, okay, some of this stuff is just, hey, you got to do it, right? So you see a lot of yeses in some cases, and then maybe one no. Okay, so the way I want you to do this is I want you to go ahead and make a flashcard of this part of the chart right here. Okay, and notice that what we have to describe the purpose for the special purpose financial statements prepared under cash, tax, whatever. We have to describe it, but we don't have to describe it for cash and tax because people pretty much understand that. But when you start getting into areas that are maybe a little more specialized, regulatory basis, contractual basis, then we say, okay, you better describe what the purpose of these statements are. Okay, so flashcard, what? Regulatory contractual basis. Yes, you have to describe the purpose. If it's cash or tax, no, you don't. Okay, flashcard that. The other thing I want you to take a look at here is right here, this regulatory basis general use. Okay, and what I described to you about insurance companies, what do? They prepare these statements following statutory accounting practices. They do what? They file those with the National Association of Insurance Commissioners. I mean, with their individual state insurance commissioners. And then you go and you can literally go to the offices of the state insurance commissioner in California. And actually now you probably do it via internet. I did it back in the day when you'd go to a reading library and you would go and you would look at their reports and you could see their reports there. So they were what? Generally available to the public, right? So anyone could walk up and get those reports, and probably now you could just download them. Okay, so what happens? Well, when it's regulatory basis and it's general use, when it's regulatory basis and it's general use, okay, and let's just come down and let's take a look and notice emphasis of matter, alerting readers about the preparation in accordance with the special purpose framework, and they say no, because now they're sitting there and saying, well, look, if it's generally available to the public, then there's nothing for us to be warning anybody about because it's generally available. And other matters, paragraph restricting the report, well, it's obviously not restricted if we're making it generally available. Okay, so notice that for these couple of cells over here, the only time that we say no to the emphasis of matter and the other matters paragraph is if it's available for general use. Okay, for regulatory and contractual basis, Yes. Okay, those, there is the restricting, because they're saying, well, wait a minute. Now we're talking about specialized accounting, regulatory, contractual, and if this report is what, not available to the general public anyway, well, now there's a smaller group that, yeah, we're restricting that report to, and so that causes it to be restricted. Okay, so when you look at the paragraph restricting, it's going to be what? It's going to be contractual, regulatory basis, unless what? Unless it's generally available, and that's almost common sense, because if it's generally available, it's obviously not restricted. Question? Okay, now we've seen don't use the non-GAAP, you know, don't use the GAAP titles, use the non-GAAP titles, okay? And then all we're going to see here, guys, is stuff that we already saw on the chart. Oh, sorry, let me go back up. So describe the purpose of the financial statements if required based on what you saw on the chart a minute ago. And I've already asked you, did I ask you to flashcard that? Right? When the purpose is described. So you can flashcard that, okay? Then we went through using the non-GAAP titles, emphasis, okay? And we say what? If required, see previous chart, the auditor should include an emphasis of matter, okay? That indicates the financial statements are prepared in accordance with the applicable framework, refers a note to the financial statements to describe that, state that the specific purpose is a basis of accounting other than GAAP, okay? So you look, again, emphasis of matter paragraph is required for everybody but who? The regulatory basis general use, okay? So you can even put here on this flashcard, okay, only not required for regulatory basis general use. Every other time, what? You had to provide that emphasis of matter. Also add to this and add what goes into the flashcard, I mean, into the emphasis of matter on your flashcard. And then also you have to say that it is an other comprehensive basis of accounting. You have to call it out as an other comprehensive basis of accounting, okay? And so flashcard that other comprehensive basis of accounting is also sometimes abbreviated OCBOA. I've seen that mnemonic for it. Okay, question? All right, good. Come over other matters paragraph, and again, they tell us to see the chart. The auditor should include an other matters paragraph that restricts the use of the auditor's report. And again, the way to remember that, you can flashcard that, but the way to remember that is what? It is required for regulatory plus contractual basis, right? Unless, and for regulatory, it's what? Unless for general use. Again, the way I'm going to tell you to think about that, do I have to provide the other matters paragraph? Let's see. I have to provide it for regulatory contractual basis, but for regulatory, if it's available for what? General use, then it's obviously what? Not restricted. Okay. Okay, good. And then I don't know if they'll ask this, but sometimes with these other basis of accounting, they may prescribe the wording of the auditor's report. If that's the case, you still provide the wording that we have learned in this class, okay, that's required by GAS, but then you could provide a separate report that follows the wording of whatever is required in the auditor's report under, say, a regulatory basis. Okay, question. Okay, again, guys, when you look at these areas and you look at these sort of, fascinating, interesting areas that we've been talking about here, the approach is flashcard. I mean, you just got to flashcard this stuff. I mean, you're not going to be able to sit there and just remember all this without flashcards. And what causes people trouble on the auditing exam is not some of the sort of basic things that we can tie up to a conceptual framework. It's all of these kind of rules that are flying all over the place. Like, you ever seen a bunch of gnats flying around and you keep having to swat them? Okay. Well, you need flashcards to swat those gnats out of the way so that those areas don't gang up on you and kill you and not let you get a good score on the exam. So you get them down to flashcards, you get used to what it is we're saying about them, kind of get your head wrapped around those, and you understand the core issues that we're really going to start getting to more, although we've already talked about memorizing the unmodified opinion and whatnot. But starting in chapter 2 next week, we're going to be having things that you can tie more to conceptual framework. So don't freak out right now if it sounds like, Jesus, we've got, rules coming flying out of everywhere here. How am I going to handle this? Flashcard. Okay. All right, good. So let's just come over. We don't need to look at those reports. Let's just come over and let's look at a, where are we? Right here. This question. Okay, guys, stop for a second. Just don't worry about this question for a second. No, don't worry. Don't even pick an answer yet. Because I made a mistake. So I want to get rid of this. So we're not ready for this question. What I'm going to do is, come on, I'm going to stop the poll. Don't worry about what you said is the answer. I didn't show you something I had to. I needed to show you. You can't answer this question. I missed something. Okay, so come back, and we're gonna have to do. You're gonna love this. We have to do another flashcard. Okay, report on special purpose financial statements. So I missed a part because I have to tell you what the key elements are of the report. I don't want you to memorize the report, but I need to tell you what the key elements are of the report, and I missed that. Okay, let me make a note to myself here so I remember that next time. Okay, all right, so sorry about that, but let's take a look. The report on special purpose financial statement has a title, an addressee, an introductory paragraph that identifies the special purpose financial statements. So that's like our introductory paragraph in our non-public company report. But remind yourselves, use non-GAAP titles. So even though you're kind of saying we have audited the, different statements, you're going to not use balance sheet. You're gonna have to say balance sheet, cash basis, et cetera, okay? A description of what? Responsibility for management, management's responsibility. So notice we're following the format. So management's still responsible for financial statements, even though they followed some other basis of accounting like cash or something, okay? So a reference to management responsibility and the applicable framework, cash, whatever it is, a description of the purpose of the financial statements, why they're being prepared, unless we had those couple of exceptions, the cash and tax basis, we didn't have to, but for all the others, we did. A description of the auditor's responsibility. Now look, the auditor will still follow GAS. It's just that you're following GAS to see that they properly followed the cash basis. But if they said revenue was $1 million, you're still going to get evidence that supports revenue of $1 million. So you still follow GAS, okay? And then you're going to give the opinion. But again, don't say we audited, in our opinion, the balance sheet is fairly stated. You use the non-GAAP titles, okay? And then an emphasis of matter paragraph that indicates the financial statements are prepared in accordance with the special purpose framework. And you're going to have to refer to a note that explains what that basis is all about, okay? And then I'm not going to get into the restrictions and whatnot, because we've talked about restrictions only relevant to relevant to everything, but if it is a general use regulatory approach, okay? All right, so notice now we come down and we look, and here's that basis of accounting that draws attention to the fact that they're using cash basis, and they would refer to a note that tells them, okay? All right, so now that we kind of cleared that up, let's just go ahead and let's look at this question together. An auditor report on financial statements prepared on cash receipts and disbursements basis of accounting should include all of the following, except a reference to the notes of the financial statements that describe, yeah, we saw that. A statement that the cash basis and disbursement of accounting is not another comprehensive basis. No, we would say what? So that makes it the right answer, in that it is something, it's not something that you would say. You would say that it is, not that it is not, it is another comprehensive basis of accounting. You give the opinion, and yes, you're going to say that you follow the standards in the United States of America, because auditor's responsibility paragraph has to be included, and you say you'll follow GAS. And that is in the in the standard report that we would be issuing here, except we'd be saying hey, we use cash basis, and it is another comprehensive basis. Of course, using the non-GAAP titles. Okay, question? All right, we've got a couple more minutes left. I find this kind of irritating, but I guess we've got to consider it in case they ask us one question here. So let's say we have a client, and the client used the accounting framework of another country. Okay, what should we do if that's the case? Okay, and so if the financial statements are being used, being prepared, and it is being prepared under the basis of another country, and the AICPA hasn't accepted that as generally accepted accounting principle, what are we supposed to do? Okay, and so they come down, and let's focus on reporting. Okay, and if the report is to only be distributed outside the United States, then we can go ahead and let's just take a look at the flashcard on the next page here. The flashcard we're going to make. You can go ahead and you can use the report of the other country, and the report would be issued by auditors in the other country in similar circumstances, that you have the auditor has obtained sufficient probably audit evidence, the auditor has complied with the reporting standards of that country. Okay, the main thing is what? Just use the report of the other country. Okay, or you could use what? You could use the US form of the report, okay, but then you're going to have to sit there and appropriately adopt it for whatever it is the other country is requiring. If you do that, you have to use all the elements of form of the report and a statement that refers to the note. Okay, so two choices: just use the report of the other country or use the US styled report, but of course you're going to have to amend it accordingly for whatever the requirements are of the other country. Okay, if you're sitting there and what report is going to be broadly distributed in the United States, now they turn around and they tell us, well, if that's the case, then you're going to have to go ahead and use the US form of the report and then refer a note that explains what's going on with this other framework that's being used. Okay, so flashcard that. Okay, question? All right, so a lot of minutia here in these last couple of pages. Make the flashcards, I would say, on those. Memorize the cards for all of the cards that we talked about. And you got a ton of them in this chapter, I realize. And then go and start working through the multiple choice questions. If you can use those, I forget what they call them, that little exercise. Anybody remember what they call those? They're
Are they
going
the
away.
skills?
Skills-based ones. I think you can use those, although Vector's getting rid of them coming up in the next version of the course. But you could go through those. Then the multiple choice questions, okay, work those. And you could take an approach where you work the multiple choice questions for all the modules. If there's a multiple choice question in there that you're like, I don't have a flashcard for this, you're more than welcome to add a flashcard that you think is appropriate for that question, okay? Because I can't give you 100%, but I'm trying to get you to 80, 90%, so add a few cards. If there's something in there that you feel would be a good flashcard based on a question you see that I didn't necessarily tell you about, and then I would go back through the modules and work the task-based simulation examples. Not every module has a task-based simulation, but for the ones that do, obviously work those. You should be really, really, really trying to get this stuff done by Monday, because Monday we're going to hit the ground running. We're finally going to get into chapter 2. Okay, guys?
Yep.
Questions?
Okay.
Should we, throughout this entire class, I guess we get to chapter 2 and 3 and all that, we should still be reviewing all the flashcards we made up until then, correct?
No, not necessarily. No, that's a good question. I think you're going to be sufficiently busy moving forward rather than looking back. Okay, so no, if you look on e-learning, I have that how to study file. And so it's kind of weird, Matthew, and I had this feeling when I was studying for the exam. I was making all these flashcards and they were helpful to get me through the homework. And, you know, I was working as a housekeeper in the hospital at the time. And I still remember, you know, this lady that was working with me as a housekeeper. I'm sitting there at the table and I have this stack of flashcards in front of me. She's looking at me like, what the hell are you doing, you know, with all those cards? And I kind of asked myself that a couple of times, like, what am I going to do with all these cards? I mean, they helped me get through the homework for that chapter, but then what? And I fully realized the benefit of those and why I advocate them so much when I got to that, you know, that period where I was going to do the final review. Then I went through the flashcards for each chapter and reworked the questions for each chapter. Chapter 1, chapter 2, all the way through all the chapters, looking at the flashcards, then working the questions. And then I'm 3 or 4 days from the exam, and that was all I did, was just sat there the couple 3 days before the exam, and all I did was look at those flashcards over and over and over again. And for for some of those questions, you end up being a machine when it comes to answering them, because you just got that so primed and geared up in your head. You're like Stephen Curry hitting 3-pointers at that point for some of those things, because you just got yourself primed. So no, you don't really need to go back to them until you get to that point where you're doing the review of everything. Then yeah, and read that final review section of the how to study, and it talks about that process.
Okay, sounds good.
How many days would you recommend to review?
Before your exam?
Yeah.
And it's kind of hard if you're starting BEC, and I realize that the way we've got these things backed up in the two, session B and session C makes that a little bit more difficult. But ideally, you would give yourself a week to review all of the material again, and then another week to do the final review. And you can probably do all those final review questions in like 3 or 4 days. There's not that many final review questions. You can do all of those in 3 or 4 days. The final review is part of your package. And then the last, 3 days or so, just look at the flashcards. So ideally 2 weeks is what you should give to go through all that. I realize that that's a little bit tough for you because we start BEC so soon, but talk to me and I will work with you around your testing date so that you'll be able to catch up if you're trying to take BEC in session C.
Okay, sounds good.
Okay. Any other questions? Okay, guys.
Well, besides the plan, I'm sorry.
Yeah. Go ahead.
Besides the plan that you set out for us to go in and pass, is there anything else that we can do on our own that also boosts our chances of coming through, complete and passing?
When you ask that, I hesitate a little bit. I'm trying to figure out. You mean like things that I know about that would help you pass that I haven't told you about? Look, you're gonna get everything that's in my head about how to pass the exam.
All right, okay, thank you.
I ain't holding back no secrets. I wish I could tell you, hey, 75% of the answers on the exam, the answer is C. But unfortunately, that's not the case. Test taking things, I hear people say, when in doubt, choose C. And my answer to you is don't you dare. If you have a question that you don't know the answer to and you have to guess, rifle through your memory and think to yourself, have I picked a lot of B's so far? If I have, then I'm not going to pick B. If it's been a while since I picked a B and I have to guess, I'll pick B. Okay. I talked to you in the first session, so you may want to go back and watch that recording about timing on the exam, all that kind of stuff. So no, if I've got an idea as to something that will help you pass, you're going to hear about it. I had a student one time that said, oh, I took the exam and I kept hearing your voice in my head telling me to do this, do that, and I was like, okay, as long as, you don't hear voices of like Abraham Lincoln in your head or something, I guess it's okay to hear my voice in your head. So anyway, I'm just being a little silly, but no, if I got something, I'm telling you. Now, that's not to say that you can't come up with something yourself. You may say, well, John, I found that it's useful to, put the flashcards in a hat and shake them and dump them on the table instead of going through them in a certain order the way you talked about. It helps me if they're random. Or when I go through the questions, I work them backwards from the front to the back because I feel I concentrate better. You know, things like that. Yeah, but check out that how to study file. I think that'll be useful.
All right, cause that's my main like thing on tests. Like I do perfect with like the practice test, practice quiz, and when I get to the main one, it's just goes blank.
Yeah, I think if I had to diagnose that, okay, or cure that, okay, I would say that you need some more repetition. If you're studying material and you're understanding material and you got it and you know kind of work through the what the hell is this stage, okay, and then you get on a test and you can't remember things that you know that you've understood conceptually, what you're missing is reps. You're missing reps. You need to go back and you need to do that enough times so that the anxiety of the exam and whatnot is overcome by the fact that you have practiced so much. Okay, that's why when you watch a great athlete, they're so good and they seem so fluid at it, and then you try it and you can't do it. You see Colin Kaepernick had a money arm, man. I mean, that ball, boom, exploded out of his hand down the field. And by the way, I'm a Raider fan. I have to say that if I mention a 49er. But, the ball just explodes out of his hand, right? You go and you try it, and the ball, got a big arc in it and stuff, right? Why? Because you don't have the reps. You haven't practiced like he has, right? So you practice, you reinforce, you practice again. Then you start getting that facility that you're going to need with this material so that you can meet the time crunch that is fairly significant, fairly recognized as a challenge on the CPA exam. Okay. Okay, guys. If there's no other questions, we're going to call it an evening. I think that Amra, you had something you wanted to talk to me about, so we're going to go ahead and log everyone else off. Okay, guys. We're going to do a little late office hour here.
Thank you.
See you next week.
Okay, thanks, guys.
Thank you.
Thank you. Good night, everyone.
Good night.
Good night.